Okay, so hello everyone. Today what we're going to be doing is unfortunately part two of this video, but what it is going to be is explaining to exactly how you can manage your risk, trading in general, but also very specifically trading to do with if you're a beginner, you're starting out, what exactly should you be doing in terms of managing your risk, your exposure, and your lot sizes. Now, risk exposure can be explained on multiple different levels and through multiple different avenues, but what we're going to do is explain it directly through using something as simple as a MetaTrader platform and trading the Forex industry and some in commodities. So just to introduce myself to you, my name is Morgan. I'm the founder of MS Equities Trading. What we do is we teach people how to trade, invest, manage their wealth. But on top of that, what I also do is I'm a third-party trader and fund manager, managing funds for institutional clients and retail clients around the world. So I spend a huge amount of time in my day studying the markets, trading the markets, and finding ways to create better performance and lower risk for my investors. And by doing so, I'm able to teach my students how to do the same thing for their own portfolios. So what we're going to be doing is just sort of a dip your toe into the situation of what we teach our students and how we do it. We're not going to give you everything. It's not going to be a tell-all, because if you do want to know more about what we do and how we teach our students, you're more than welcome to join up in our academy and come and train with us. We train students from around the world. But to get started off with, what we're going to basically be doing is using an example of 1 month worth of trading to show you exactly what I mean by a retail trader starting out. So basically the rules are the account has to be around $1,000, and we are going to show you exactly how we take I take $1,000 and I turn it into profit. And I'm going to try and find out how much profit I can make. And now trading an institutional account, where there's a few $100,000, it really, I can't help teach you that. It's like trying to learn how to drive a car in a Formula One car. You have to start off with the small car. And that's what we're doing now, is we're going to use a small retail account, $1,000 account, and I'm going to show you exactly how I manage my risk exposure on this account. And on top of it, this is the account we call our retail aggressive account. So it's basically a very aggressive account where I tend to push for anything between 5 to 7% return every single month. And my goal is to net anything above 50% by the end of the 12 months. So what I've actually done is I've extracted an account statement directly from my brokerage account. So it's the BD Swiss brokerage account that I'm making use of. It's just a retail brokerage that we use. We're usually using institutional brokers, but what I'm doing for the purposes of this video is using a retail broker as well. So on this account, we've got a 1 to 50 leverage. There is $1,500 in the account. And these are just all of the transactions that you can see here. So you can see, so there's some orders that have been canceled. So all of the information is here. What we've decided to do is extract all of that information and put it into a Excel spreadsheet, which makes it a lot easier for me to run through it and show you the information. So as you can see, all of this information is, you can see the close times here. The first trade we had closed was the 1st of August. At 10 in the morning, and the last trade that we closed was 9 minutes past 7 on the 30th of August. So you can see all the positions here. The ones marked in green are the currencies, ones marked in orange are the commodities and the energies. And I traded one trade on Twitter, which is what I'm calling as my derivative as the derivative I traded. And basically there is 66 trades that we marked in the month of August, and these are all the positions. The only thing I've taken out of this thing here are all of the cancelled orders. So let me just quickly pop it up here. You can see there were quite a few orders that I had cancelled, and I just basically removed those from this spreadsheet just because those are not metrics that we wanted to calculate back down on the bottom. But basically what I wanted to show you is exactly how I was able to return 9.65% in the month of August. And now that was quite a good month for us. It is the best month on this account. But for myself, what I tend to focus on, as an example from my institutional clients, I'll try and focus on anything between 0.95 to 1.7% every single month. So I'm focusing on a very, very low threshold. Whereas for this account, I'm doing a retail aggressive account. So I'm focusing on anything between 5 to 7% return every single month. But on this account, we managed to swing for the fence on a few positions. So some of the highlight positions were shorting euro pound, going long and short on pound Japanese yen. We also had some other positions out on gold. Sadly enough, a lot of people thought it was crazy that I was going short on gold. I did go short on gold. I went long as well, so I'm still long and short on gold. I'm wondering where I should close out my longs. And I'm short as well, so I'm wondering where I should close out the shorts when they come into profit. Unfortunately, August was a tough and volatile month, and September has been an absolute monster of a month for volatility. Everything to do with North Korea and all the other sort of countries involved in the problems right now. ECB came out today. They're not going to raise interest rates. They scrapped the Dreamer immigration plan yesterday. So it's been a very, very rough month for the financial markets. And what's happened is a lot of people are moving to gold as a safe haven. And the problem is I'm long gold, which is good, but I'm also short, which is bad. So I'm trying to work out exactly where I want to be out of my longs and where I want to hold my shorts at. And I'm probably going to add to those positions to cover the short side loss. But basically what we did on this account was I had 66 trades executed. So let me just zoom into these metrics here. So there were 66 trades executed on this account. And of those 66 trades, I had a 75% win ratio. So on that 75% win ratio, what it basically means is I won 50 of the trades and 16 of the trades were losses. Now, something you also need to realize, on some of these positions, I had them hedged. So say, for example, on pound CAD, I went long at 0.02 lots and I went short at 0.01 to cover in case I did go into a bit of a loss. I thought that the market did have a little bit of room to move lower, so I entered a short as well just to try and see if the market moved low, I was going to cover that short and profit, and I was going to add to the position and wait for it to move back into profit. So I'd have two positions on going long pound CAD in profit. And unfortunately, on I think 4 different occasions, I had this where it actually didn't move lower, so I still made money on the position, but I had to close out my cover position, my hedged position, in a loss. So the win ratio, even though it's 75%, we would have expected it to be anything in the region of 78 to 83% if I didn't have to have hedged positions that I closed in a loss. But that's just one of the strategies we make use of. But in terms of the profit factor, we're looking at a profit factor of 2.95 times every single profitable trade. So basically, that's meaning we're making $2.95 as an example every single time we win, and $1 every single time we lost. So that's just a ratio that I'm very happy with. So for the ratio on that, the profit factor, I like to keep it anything between 2.5 to 3.2. Anything above 3.5 is considered very good. And for a 66 trade ratio, that's quite good. 66 trades are, it depends. That can be on the high side. But given the fact that I had multiple positions on certain pairs, as an example here, there were like 3 positions on pound CAD. That's the one I was talking to you about. So I had 2 buy orders and 1 sell order. So that's 3 trades on just 1 position. So these 66 trades are not on multiple different positions. A lot of them are on similar positions, which means I might have only looked at 9 to 20 different instruments across the month of August, which is not that bad. In terms of my average win, these are the metrics that I weren't very happy with, but in terms of my average win, I was looking at $2.48 per win, which I think is a bit low, and on my average loss, I was looking at $3.97. So this is the one metric I know is not working very well in this account, is my loss is exceeding my win. Even though my win ratio is 75%, that's still not good, because even though I'm still making money with my average loss being higher than my average win, that means that if I get a streak of losing trades, I'm going to lose more than I win over a net time frame. So that's my main focus, is going into September. I'm actually taking some time off next week. I've taken time off this week on trading. So I'm just going to be holding my gold positions and leaving this month of trading for a bit, just to take some time off. But in terms of going into October, that's my biggest focus, is to see if I can push my average win up. I'm going to try and see if I can push my average loss down. And then my average net is working out at $1.88 per trade. So I'm basically averaging a profitable ratio of $1.88 per trade, which I'm very happy with. But that is one of the metrics I want to work on. One of the other metrics I want to work on is to try and keep my profit factor in that region of 2.95. And the third one is to try and keep my win ratio above 75%. I'd like the win ratio to move into the region of 80%. Win ratios are very controversial. You've got some people that say anything above 50 is good. The next person says anything above 60 is good. So don't be too worried about your win ratio. You need to focus on making money. If your win ratio is like 40%, but you're still making money, then that's fine. But for myself, I know very carefully that I need to try and keep my win ratios up, because I do enjoy trading very short-term positions when the positions are not going right. So a lot of these positions are positions that have been stopped out that weren't performing well. So when it went into profit, I'd move my stop up, market would come back down, hit the stop, be out of the trade. So even though a lot of these positions hit the stop losses at 3 pips profit, 4 pips profit, the forecast was trying to get them into 20, 30, 40, sometimes even to the few hundred pips profit region. And for me, I'm fine with being out of a trade in profit and the trade moving for the next 10 days into more profit, rather than holding a loss on my portfolio. I really don't enjoy holding a loss on my portfolio. Now, every single trade is different. I know traders that don't mind holding losses on their portfolios and others that do. I prefer either, if there's a loss, the position is hedged, and if there's a moving loss, the position is hedged, and if there isn't, then I prefer them only being in profit. So this average win is a very important metric that you need to understand when you are going into your retail trading. And the last one is probably going to be the surmise of this video. This is going to be one of the most important things that I'm experiencing majority of my students are struggling with understanding, and majority of other traders that I speak to are also struggling to understand. Now, you have a lot size. So that lot size, people can trade at $1 a pip, $10 a pip. Obviously, they want the highest possible lot size because they want to make the most amount of money. But what I'm saying to them is, don't focus on your performance, focus on your risk. And what's actually happening is, in the industry now, this is coming from my personal experience, is I've been able to speak with multiple clients in the industry who are long-term investors in things like mutual funds, hedge funds, retirement, private equity, venture capital. I've spoken with hedge fund managers. I've spoken with institutional clients, brokerages. I've spoken with many people in the industry that are well respected in this regard. And all of them have been saying this year we need to focus on risk off. And risk off means being away from the risk. So risk off means if there's nothing really happening in the market, try and stay out of it, kind of thing. And if there's too much happening in the market, still stay out of it. So what we're basically doing this year is, I sat down with my investors and we came up with an idea of where we wanted to go with the portfolio this year. And the general answer and the general feedback was, let's be risk off. Let's make sure we don't go into too much risk. And I think that being able to see that unanimously from so many different people, and being able to, not even with people that invest with me, but people that I know, as a network, and colleagues of mine and friends of mine, they all are looking at a risk off strategy. They're looking at how can they make money with the least amount of risk. So let's say, for example, you want to trade at $1 a pip. Now that is a massive amount of risk. Whereas let's say the smallest lot size is 0.01. So what happens at 0.01? It's 10 cents a pip. It's the smallest lot size you can possibly execute. So that basically means you're at the lowest possible risk exposure that you're able to expose yourself to at 0.01. Now the thing is that this is varying on your account size. So let's say, for example, you have a $200 account. which I wouldn't recommend, that is still a lot of risk. You know, you can lose 2,000 pips and be straight out of that account immediately. And that's very difficult. You can, as an example, have a $10,000 account and trade at 0.01, and you'd have to lose 100,000 pips in order to lose $10,000, which makes it almost impossible. So your risk exposure on a $10,000 account is basically 100,000 to 1, whereas your risk exposure on a $200 account is 2,000 to 1, which is a lot more of a risk than being on a $10,000 account. Now, on this $1,000 account, I basically am using it as an example portfolio, showing you exactly what we do on the portfolio. Now, for myself, I manage the multiple different portfolios, and basically what you can expect is that we manually are copying the positions. So if I'm entering on positions here, you can expect it to be on my other accounts as well, but I am not doing it at the same risk exposure. I'm doing it maybe a little bit less risk exposure, because the bigger the account gets, the more risk I want to not take. Whereas when it's a $1,000 account, I don't mind taking a bit more risk, and that's why I'm able to produce something like 9.6% in a month. Now, that's what I need to try and make clear to you, is this is not always going to be the case when it comes to yourself. You're going to want to try and push your risk exposure, but that is more specifically why I have to show you this metric and actually show you, even when risking 0.01 on a $1,000 account, I can still make 9% per month. And I have a funny feeling that going into October, like I said to you, September, I'm not going to be trading too much. I have a funny suspicion going into October, I can reduce my risk exposure even more and increase my performance. And increase my return. So basically what the focus is, when people think you have to increase your return, you have to increase your risk. And generally speaking, this is true. But now you can fine tune it. Let's say, for example, we are making 10% per month at 20, let's say a lot size of 0.04 per month. Now, let's say the next month, we want to still make 10% at a lot size of 0.03. So what's happening? Our performance is staying the same, but our risk is trying to go down a bit. So we're trying to reduce this risk as much as possible. So let's say in the second month we do it. What are we going to do in the third month? Now, the third month we're going to say, let's still make 10%, but let's go push our lot size, so our risk exposure, down to 0.02. So now we've gone from 0.04 in month 1 to 0.02 in month 3. And let's say we hit it again. Now, that's amazing because you've been able to reduce your risk by 50%. So you've been able to halve your risk while still producing the same amount of returns. And say, for example, an investor sees this, they're going to be amazed if you're consistently able to either manage a low risk exposure or keep reducing that risk exposure while still maintaining the same average results. So if you're averaging 10% a month, that's really good. So now let's go into month 4. Let's say month 4, you say, well, I want to reduce my exposure even more. And you go down to 0.01. Now you're at the minimal exposure possible. You can't go lower than 0.01. And you, let's say, for example, are still producing 10%. Now, what you've done is you've reduced your performance by 75%. So you've reduced it from 0.04 to 0.01. So you've taken 3/4 of your exposure off, but your performance is still the same. So that basically means your risk exposure is so low that by producing a 10% return, if you put your risk exposure back up to 0.04, and this is where the very special thing is, if you put your risk exposure up back to 0.04 after the 4 months where you've done 10%, 10%, 10%, 10%, 4 months in a row as an example, but reducing your risk, when you push that risk exposure up to 0.04, you'll be able to theoretically produce a 40% return in the month of the 5th month. Now, this is completely theoretical, but what I'm trying to say is that's how you have to understand performance versus risk. And what people don't realize, the true practice of becoming a better trader is not by trying to push your performance up, because that obviously actually pushing your performance up is like lifting much heavier weight, and you're putting your body under a lot of stress. Whereas with your risk, that's like working on technique more. So now when you're focusing on reducing a risk, you're becoming a technique-based learner. So you're actually learning, how can I do what I'm doing better with less effort? Now, that is where the professional traders tend to focus on. They're trying to say, how can I still make the same return but just risk less? I want to put less in the market and get the same amount out. Not saying I want to put less and get more, because that's being a bit hopeful. And not saying I want to put more to get more, because that's being a bit brave. And what they're basically saying is, I want to put less, I want to still get the same amount. And that is where in the 5th month, you can increase your exposure slightly and your profits are going to rise. So basically what you've done is you've kept your profits at the same level, but you've reduced your risk. And the 2nd and the 5th month, you say, I'm practiced, I know what I'm doing. You increase your risk and your performance goes up. And this is the very specialized part that I'm trying to show you on these track records, is exactly how you can do that. Now, as you can see in the lot sizes section, what I've done is I've split the 3 things I traded on this month into currencies, commodities, and derivatives. Now, the most traded thing is currencies. That's pretty much all I trade. I do trade commodities, so I trade gold sometimes, and I trade oil. I don't really trade any other commodities. And derivatives, the only reason why I had a position on Twitter is because I had a funny suspicion after earnings they were going to see a recovery. They didn't. I got stopped out for I think it was a $2 loss on both positions. So it was like $1 loss per position. It was very small. I went back to trading currencies. So in my currencies, I traded a total lot size of 0.85. So on all of my positions, and what you can see up here, you can see all of the positions. I mean, 0.04, 0.02, 0.02, 0.01, all of these at 0.01. So what you can see is when I traded the total trades at 55 trades on currencies, my average lot, so what I did is I divided the total lots into the total number of trades. My average lot was 0.015. Now, what that effectively means is I was trading at under 0.02 per trade. So an average of under 0.02 per trade. Now, that is really, really good because my risk exposure is nearly at the minimal risk. Because what's my minimal risk exposure? 0.01. But this is at 0.015. So I'm slightly higher. So I can reduce my risk even more. And that I think is something amazing because still producing close to 10% every single month, I still have room to reduce my risk exposure. Now, the risk exposure trading commodities averaged 0.024. Now, the reason why I put commodities in a different one is my margin requirement trading oil on this account is a lot lower, which means I have to put in a lot size of $10 a pip just to be able to make the same amount of leverage because the oil instrument is not leverage. So the reason why I did that is to split it up because on oil, I'm trading much higher leverage, whereas I'm still making less than if I traded at 10 cents a pip on currencies because that instrument is not leveraged like the currencies are. So it basically means I have to increase my risk a lot more there just to be able to make the same amount of money, which is a completely different metric, but we don't have to worry about that. But more specifically, the reason about trading at 0.015 means that I'm almost at my minimal risk exposure and I can still produce 9.62% per month. Now, what my focus is going to be, and if you look at one of the previous month's videos, I was able to produce, I think it was 8.6% in July, and I think it was June. And that was a very, very good exposure video because it showed how you would be able to do the same thing I'm doing now with a small trading account. And my main focus is to help teach you, you can still make money on $1,000 accounts trading at such a small risk exposure, but that is where you need to go. You need to focus on starting off at a risk exposure of like 0.01. And I'd say, for example, I usually use this metric of I'd like to see you trade 500 profitable positions on a live account at the risk exposure of 0.01. And this is what I use on my team of traders as well. I don't back them with capital until they give me a proven account statement on a live account with 500 profitable positions at the risk exposure of 0.01. Because if I know they can do that, if they can be patient enough to do that, then I know I can trust them with increasing their risk exposure and going onto a bigger account. But still, the same reason is, so let's say at 9.62%, I'm trading at 0.01. So I can't trade less. So I'm expecting to make that amount. But what if we increase the amount of money? And that's what I did here, is basically in this metric here, and we can talk about the colored table just now. In this metric here, I showed you, so the original data is over here. So the original data is an account size of $1,000 with average lots of 0.015. So that's the average I executed on that position, and that produced me a 9.62% return. Now let's say, for example, we times this by a factor of 10. So we times both metrics by a factor of 10. So let's say we have a $10,000 account and we still want to make 9.62%. What would have the lot size been? Well, you times the lot size by 10 and you come out with 0.15, which means we would have traded at $1.50 per pip if it was a $10,000 account. If we did that, we would have produced 9.6% return. Now what we're doing is we're scaling our lots. So now we know exactly when and where our lot sizes need to be and what the account size has to be to make 9.62%. So here I would have made $962 off a $10,000 account. Now that is a very good return. You know, in a month is very good. You know, for me, I'd only try and expect anything between 4, maybe 3 to 5%. And on top of that, I don't usually withdraw my profits. I leave it in the account so it can compound properly. And let's say on a $100,000 account, we would be trading a lot size of 1.5, which is $15 per pip. So at a lot size of 1.5, if we had a $100,000 account, 9.62, we would have made $9,620. Now that sounds better than making what, $96 on this account. You know, on a $1,000 account, we're just making $96. But on a $100,000 account, we can make $9,600. Now, if we did this on $1 million account, what lot size would we trade at? Well, we would trade a lot size of 15 lots per trade, which means that we would have been able to make $96,200. $96,000 sounds awesome. That sounds really amazing. But that's what I'm trying to say to you, is you need to scale your lots and your risk exposure. But now, if we're at 0.015, we're at the minimal risk exposure. So there's not much more we can do here, which basically means that a $1,000 account, we can't reduce our risk much more. What we can do is focus on a metric like being able to increase our average win and reduce our average loss. By doing so, even though our metric of the lot size is at minimal exposure, doing that, we will be able to maximize our profit and minimize our loss, which means our average net win will be much higher, meaning we can make, let's say, off the same amount, extra 4 to 7% every single month. And that's why I'm saying to you, on this account, what do I know? So I know two things. I know my risk exposure is basically the smallest it can be. Number two, I know my average wins is not high enough. So my average net, which is over on the screen, is not high enough. So my focus is increase your average net win and you will make more return. So I've carefully analyzed this, and I know going into next month, all I need to do is focus on increasing my average net win. And that's important. So that's where the focus needs to go into it. where you're focusing only on your average net win every single month. So that's what I'm going to be focusing on with this account. Now, going into what I did for you here, this is a simple metric that I make use of to show people how they should be scaling their lot sizes. Now, this is very, very simple. I didn't really take too much time to do this because I didn't want to show you and confuse you with too much metrics. But basically what we've got here is, this is starting off with $1,000 account, okay? And this is obviously color-coded to what the lot size metric is. So this is the account size. These numbers here are the account size. We've got $1,000, then we got $5,000, $10,000, we go up in a metric of $5,000 all the way up to a $60,000 account. Now, I'm hoping everyone that's going to watch this video is not going to be using more than $60,000. If you do have more than $60,000, I hope you know how to manage your risk. Because if you're watching a video about how to manage your risk and you got $60,000, that's a bit worrying. But basically, what I'm showing here is if your lot size is minimal at 0.01, so we can't go higher than that. We literally cannot go, lower than that. Then that's what the metric is going to be. So you can see it's color-coded here. At $5,000, what should your metric be? So your metric should be 0.025. That's what I feel starting out, you should scale your metric. So at 0.025, that's basically 25 cents per pip. Now, that is still scalable, it's still healthy, and also on that risk exposure, you can still reduce it. So that's where we're talking about how can we reduce our risk and increase our performance. And that's where these numbers are going to be important, because now you can reduce that risk to like 0.01 and still try and see if you can make the same performance. Now, on a $10,000 account, I usually say 50 cents per pip. Now, 50 cents per pip is 0.05. And as we go, we keep on scaling it by an increment of 0.025. So it's an increment of 50% on the base amount. So basically, as you can see here, we're going up to 75 cents a pip on a $15,000 account, $1 a pip on a $20,000 account. And now this one in blue is going to be important. On a $20,000 account trading at $1 a pip, now at $1, you can focus on scaling that metric, that risk exposure back down. Now, let's say, for example, you're making the 10% on a $20,000 account, you're making $2,000 a month. That's a nice return to have. But let's try and see if you can reduce that exposure and you can try and go from trading at $1 a pip to trading at like 75 cents a pip or 70 cents a pip or down to 60 cents a pip, but you can still maintain a return of 10% every single month. Now, that is going to be very, very good for you to try and see if you can manipulate your metrics to try and maximize your performance by reducing your risk. And you know, slowly but surely, as you practice that and you get better and better, sooner or later you can raise your exposure again and make a serious amount of money. As we keep on going down, we go, let's say, to the $40,000 account, we've got an exposure of 0.02, so 0.2, so that's $2 per pip. Now that's now getting a bit nicer. So at $2 a pip, basically, you know, if you're trading at $2 a pip and you've got less than $40,000 in your account, you're probably exposing way too much to the market. And this is very important for you to understand. I'm really being serious about this. And, I think that a lot of people expect that you should be swinging for the fence, you should take massive risks. That's where you're going to blow your account. And I think it's very important for people to see these numbers clearly. Going into $60,000 as an example. So let's say we've got $60,000 in our account. What risk should we be trading at? I've put down here 0.3. So that is $3 per pip. And, I think this is very important. I think that trading at $3 per pip is definitely what I expect someone to be able to trade at. And, I think people don't necessarily respect the fact that, when you start out, you should be able to do certain things. I really think it's almost like you have to almost do your time. You almost have to be able to do those 500 trades at 10 cents a pip. And, I think that would be something I'm probably going to implement, is saying to my traders, you need to first trade 500 trades at 10 cents a pip, and then we'll promote them on a risk exposure system. So I'll actually be building a automatic risk exposure system that limits their risk depending on whose account it is. So let's say, for example, your first 500 trades is limited to 10 cents a pip. So lot size is 0.01. Then we promote you and take you to 50 cents a pip. And the next 500 trades is at 50 cents a pip. And then we go up and the next 500 trades. And usually the reason why I say 500 trades is I expect someone to execute 500 trades over 12 months. Now that is, depending on who you are, that is slightly high, and for some people that's slightly low. But what I'm wanting is 500 trades over a 12-month period. No more than 500 trades. So you can't trade massive amounts, and I want it to be averaged over the 12 months. Now at 50 cents a pip, that is very good. You know, at 500 trades a year, at 50 cents a pip, you can make a good amount of money. And we're going to keep on going up in increments of 50 cents. So going up to $1, then $1.50, all the way through. And after 5 years worth of progressing and trading, then we can say to them, okay, you can go on to the big lots, trading at $10 a pip, $15 a pip, $20 a pip. But the thing is that if they go through all of that over 5 years, so they know how to trade all the way from the minimum account sizes, by the end of the 5 years, they are probably going to be able to manage risk better than most professional traders in the industry can. They can probably be able to do things like make money better than most of the people in the industry can. And they'll be able to understand the metrics and understand exactly where they can find higher performance and they can find lower risk. But now, to end it off with, if you don't actually think that dedicating this amount of time to learning how to become better at trading then I don't think trading is important for you. I don't think you should be trading. Trading is a frighteningly difficult thing. It's a scary numbers game, and there is a lot of very important metrics that you need to understand. But people aren't willing to put in the time. People aren't willing to do things like this. They're not willing to do 500 trades at 10 cents a pip. And that is exactly why I'm doing this thing. I've been trading for over 5 years, yet I will still go back to 10 cents a pip and trade at that. And I'm going to continue to trade at this, and I'm going to make sure I can get to up to at least 10,000 trades trading at 10 cents a pip to make sure I can keep on practicing and understanding my risk and becoming better and better. Because I know at one stage in my life, I'm going to be able to get to trading the multi-million dollar portfolios, trading at $100, $200 a pip, and be able to make a massive amount of money. But if I don't start somewhere, how am I going to become the best at what I want to be the best at? And that is the sacrifice you have to make. So to everyone who has gotten to the end of the video, something I want to leave you with is something I've actually got stuck up on my wall. On my wall, I've got this stuck up. It's the top 10 performing hedge funds in the industry in 2016. Now what you can see here is there's 10 groups that are on this Word document. Some of these groups are very, very good hedge funds. And you can see the average return from 10 of the best hedge funds in the world is 10.174%. Now, you have to be very, very understandable of this. 10.174% per year. And I've got students that come to me and say they want to make 100% in the first month. They're like, no, they want to turn $5,000 into $100,000 in the first year. And I'm trying to say to them, then why aren't the hedge funds, why aren't the biggest hedge funds on the planet, with some of the most intelligent and skillful people in the world, able to do that? And there's no discreditation that you can put in front of me that will prove you can do it. And that's what I'm trying to say to so many students is focus on something like this. Focus on a risk exposure where you can make 10% per year, you can make 20% a year. And slowly but surely you can scale it to the point where 5 years down the line, you can be doing things like trying to find ways to make 10% every single month on the lowest risk exposure. For myself, I know if something goes really wrong on my account, I'll be able to manage it because I'm on such low risk exposure. And that is very important for you as well to understand. And that's something I want you to take home with you on this video. If you don't want to dedicate yourself like a professional, how do you expect to become the best? It's a simple metric. How do you expect to become the best if you don't act, if you don't trade, if if you don't study like a professional does. You will never amount to any level of serious success unless you dedicate yourself to this level. And I have to be very blunt with this statement, because there are so many people that think this is the easy thing to do. It's not. It's frighteningly difficult. For me, I'm dedicating, I'm working an average of 11 hours a day, 7 days a week, to be able to produce serious returns, to be able to run a company, grow a company, be a professional trader, and be able to, on top of it, study and grow all the time. And that's the thing, is you have to dedicate yourself at that level if you want to succeed. And if you fail, don't blame the markets. Don't blame bad conditions. Don't blame black swan events. Don't blame Donald Trump or North Korea or the next bloody thing. You have to blame yourself, because at the end of the day, if you're not dedicating yourself at this level, you are never going to succeed. Now, to everyone who is interested in actually coming on board and learning about the system that I've built. So what I did, I took everything I know about trading, about investing, and about wealth management, and I put it all into an online training program. So it's an online training academy. You are able to access it from anywhere in the world. I've got students training from over 25 countries around the world. You're able to go onto our website, msequitiestrading.com. You can find out more about us, who we are, and on the training section, you can also find out more about our training programs. In the training program, it's a 12-month access, provides you academy training on all levels, so all of the online content available for one cost, and including unlimited private coaching directly with me. So what that basically means is there's no upsell, there's no extra cost you have to pay, no subscription fee. It's a once-off cost, gives you access to our entire academy for 12 months. If you want to renew it, there's a very, very small admin fee you have to pay to renew it, and you can continue to stay part of our group as a student, as a trader, and as a friend to the company. Now, to everyone, I hope you have a really good week of trading, a really good week of studying. Make sure to have a look at the rest of our videos. We got some nice information up on the YouTube page. Like this video if you liked it. Make sure to subscribe to keep updated with all of our content, and hope you have a lovely day further. Cheers for now, everyone.